I'm very glad to be joined by a great list of investors here who look at startups in their different life cycles and trying to decide what are the ones that deserves their backing and trying to make the best predictions about the future. So maybe to kick it off, can you give us a little bit of introduction, what you do, what your focus, and how AI has shaped your stage of investment?
Hi, my name is Vijay Reddy. I'm part of Mayfield Fund. We're a 55-year-old venture fund in Menlo Park. We invest at seed, A, and early growth. We've been investing over 550 investments, 120 IPOs. And we try to invest in startups which are, we try to find the founder fit. So we're a founder-friendly fund. In AI, we're investing across the stack, all the way from hardware to middleware to models, data, and applications. And we're extremely active across the different stacks. So I focus mostly on seed. My partners focus on A, and we have a partners focusing on early growth as well. And we're investing in what we call the AI teammate economy, which is a $6 trillion economy. Happy to chat more.
Yeah, thanks so much for having me. My name is Ryan Isono. I'm a managing director at Maverick Ventures. We are the venture arm of Maverick Capital. We've been around for about 32 years. We invest all the way from incubation through post-IPO. So we have a venture fund, a growth, and actually a silicon fund now, as well as a hedge fund. And so it's about a $11 billion platform all in. I focus on the earlier stages, so inception through Series B. And yeah, similarly, we invest again from all the way the hardware stack, all the way through the application layer. And in terms of how it's changed, what we do and where we focus, I mean, I think it touches basically everything. Every company we look at, I think now has some angle, either obvious or a derivative of how AI is impacting every single sector, whether it's horizontal, whether it's vertical, whether it's application, whether it's infrastructure. So it really is just touching everything we do these days.
Hi, my name is Tilly Bannett. I'm with Pinegrove Ventures. Pinegrove Ventures was previously the equity arm of Silicon Valley Bank. It's an umbrella firm that invests in both private credit, a fund-of-fund, and direct tech equity investing. We have been around for about 20 years and have been investing traditionally at the Series B and beyond, so early growth. As it relates to AI, there's I'd say two parts. One is we've invested in almost all of the foundational models with the exception of OpenAI. We use AI within the firm. We have about 14 data scientists. We use AI pretty extensively as we do our own due diligence. We run automation of the actual sourcing process as well as the deep dives into the companies with AI. So it's been quite interesting to both be on the user side as well as on the investing side as it relates to AI. And fun fact, we worked together about 4 years ago.
Yeah. I'm James Detweiler. I'm a partner at Felicis. So Felicis has been around 20 years. We're currently investing out of a $900 million fund, and we do seed, A, and B rounds. I like to say there's two things that differentiates Felicis from the rest of the pack of VCs. Number one, we are hyper flexible. So any sector, stage, geography, ownership, we try and just meet the best founders where they're at. And then the second thing that differentiates us is we're very founder friendly. So we have something called the Founder Pledge, where 1% of every first check we write goes to founders for professional development, mental health and therapy, executive coaching, the things that founders tend to not invest in the early days of starting a company, but should. So we kind of cover that for them. The question was how AI is impacting our job. The obvious answers are around due diligence with things like deep research, or even note-taking with things like granola, but that's obvious. I think everything about the job of the private market capital allocator will change because of AI. In fact, I want this to happen. I think VCs are, in general, pretty inefficient at allocating capital. And I think right now, there are these new tools that kind of just arrive from outer space that can synthesize research and eventually make decisions better than humans. So I'm really interested in thinking about how AI will not just help humans make decisions about how to allocate capital, but actually allocate the capital. So if you want to talk more about that, I could, it's something I very firmly believe in.
We'll come to AI's impact on job replacement, including VCs in a bit. But go back to everyone's point. It's really interesting to hear that we got a pretty wide views of funds that focusing on different stages, and the fund sizes are different, which may also impact your how you think about asset allocation. So I want to kind of talk about that from the lenses of which stacks of AI that you are spending most of the time on. Tilly, interestingly, you mentioned you guys are in every foundation model company except OpenAI. I'm curious what's the thinking and the rationale there, and how much everybody else spends on foundation model versus other stacks in AI.
Yeah, we pretty early on came to the conclusion that we think there will be a pretty massive consolidation where the foundational models will be the dominant players across the entire stack. So they'll continue to source hardware and infrastructure from other players, but they will be the models that will be driving a lot of the applications. And so we've seen that with recent plays like OpenAI, the play that they had on Windsurf, and likewise with Anthropic going into Claude Code, et cetera. And so the way we see it is that as these foundational models become more and more dominant and have more market share, they will go up the stack and provide applications themselves. That doesn't mean that there won't be standalone application companies that are doing very well. We just think that there is a pretty large risk in consolidation from the large foundational players.
What are the reactions from other panelists who do look at the application side?
Yeah, I'm happy to go. I mean, I think we have a similar view, especially, since we invest from the earliest stages all the way through, publicly traded companies, and through IO, which OpenAI, recently acquired Johnny Ive's company. We've, I guess, got direct exposure to OpenAI through that as well, which is, of course, more of a AI hardware company. But yeah, no, I think I generally agree. I think, if you were to look back even 6 months ago and how all the labs were attacking the application space, and you look at it now, I think it's very clear they're continuing to move up. I think one way we think about it is, what does the messy middle look like, right? I think a lot of these horizontal applications that live really close to the model layer, I think as we're already seeing, and CodeGen is a really good example, that's such a natural extension of their existing product suite, right? I think, the further you get into whether it's more niche areas or ones that require more, let's call it forward deployed engineers that are really learning these workflows that aren't necessarily purely digital, but can be either physical and or, trapped in the brains of these knowledge workers, right? That haven't really been captured yet. I think there will be a lot of room to run, and even in these spaces that I think, I incorrectly thought were going to be eaten by the model providers, I think you see tons of, very successful companies, whether it's, Cursor on one hand, whether you look at, Sierra and Decagon in the customer support space, those companies, I think you could argue in the early days were very close to what the model capabilities were themselves. And I think some of these breakout companies are able to move very quickly and establish themselves as winners. And so, I think all of us would be out of a job if the only thing that was going to be created in terms of value was the model providers, right? And so I think it's finding the right founders in the right areas to attack. And I think if they can execute quickly and, again, solve the pain point in a very differentiated way, I think you can create a lot of enterprise value over the long term. So
I'll take a slightly different view here. So if you look at the enterprise infrastructure stack, right, the hardware, we don't invest against NVIDIA. There's a lot of surface area around that, right? Like silicon photonics, memories, interconnects. That's a place we're very active in. As you go up the stack, when you look at models, for us, if it's language, text, it's huge CapEx. It's a lot of data. Companies like Google, others are extremely well capitalized and have the infrastructure to go after that space. So why go invest? Is that really venture scale? I think that's one question we have. But then there are models outside of this, right? For example, we invest in a diffusion for text model. We're looking at like chemicals, material sciences. So there's models to be built across the periphery of that, outside of language, text, speech, and video maybe. But a lot of the value is accruing towards the application stack, where workflows are embedded within enterprises. There's data behind firewalls, like we said, forward deployment engineers. So the other bigger piece we're looking at top of the application stack is what we call the AI team meta economy. This is a lot of the workflows which humans used to do are being automated by AI. And these are not traditional SaaS replacements, but these are actual human augmentation or human maybe replacement in some cases. But that's a $6 trillion economy. It's like an order of magnitude bigger than SaaS. So that's a space we're very, very active in. But across the entire stack, like security, safety, trust, we're investing everywhere else.
James, I know you look at both the more picks and shovel plays as well as applications. Where do you stand in this kind of a two-side views in the panel?
Yeah, so with respect to applications, the most interesting question I think is, what is the next domain of work to get basically automated by AI? And we've seen obviously open evidence and a bridge in healthcare. We've seen Decagon and Sierra in support. We've seen legal like Legora and Harvey. But what's next? What's the next app company that everyone's going to be talking about? And I basically use this heuristic to figure this out. I have no idea what the answer is, but I use this heuristic to help me figure it out. I look at domains where action space is constrained, like what an agent can do is not infinite. That like those domains will be impacted first. Then I look at low consequence work. So loosely speaking, this means like customer support will be automated before compliance, because like if you get something wrong in compliance, that's bad. And then the third thing I look at when determining what that next kind of floodgate will be to open is the modality of data that the work tends to deal with. Is it an all-text job like legal? Is it text plus images plus video and maybe one day 3D point clouds? That will probably be later, be automated later. And then the fourth thing I look for is just how many people are doing this job and what is their median salary. So it's just like a dollar number. So like with that heuristic, I've worked internally at Felicis to figure out, okay, what is that next kind of domain? And one idea that we have is around healthcare admin and like back office healthcare tasks. And these weren't quite in reach maybe like 2 years ago, but now you've got the buyers warming up to it, you've got the technology getting better at the kind of tasks that comprise this work. And I think there will be a company like Decagon and Sierra, but in pure healthcare back office admin that everyone's talking about in a year. So I'm trying to make an investment there right now. But yeah, that's kind of the heuristic I use to look at apps. With respect to infrastructure, we've made investments in foundation models, but slightly differently than what Chili said. We focus kind of on the non-text foundation models. We have Skilled in robotics, Poolside in code. We have Runway in video. Then we've also made a ton of like data infrastructure investments, and that's kind of not where I focus, but we've tried to have kind of broad exposure across apps and infra at Felicis.
I have a follow-up question on the application layer, since we have a lot of founders here. In the kind of more obvious categories you mentioned, code gen, customer service, like people know there is a lot of value to be created, and there are already a lot of successful startups here. How much first move advantage these companies will hold. And you have seen the code gen spaces were really interesting and fast moving ones. Like now with clock code is really catching up and gaining momentum. And how should entrepreneurs thinking about entering those quote unquote more obvious categories in terms of AI applications now?
I just want to bring up one point as it relates to the application side, and specifically Cursor and others, is the question about the unit economics, which I think a lot of the VCs are grappling with these days, which is, if a user is paying Cursor $200 for a subscription, but Cursor's paying Anthropic $300 for the tokens, and then Anthropic is paying AWS for the cloud compute, and then AWS is paying NVIDIA. There's this supply chain, which is very interesting. I think we as VCs, when we look at companies that are focused on the application layer, like a Cursor or Windsurf or others on the code gen space, we will be looking much more aggressively at how do you scale and how do you scale on the unit economics front. And so this is relevant for any vertical or any category. And this is definitely something that I would say, if you are a founder in that space, is to really think about how you build a product that scales with margins that make sense.
Yeah, I think for founders looking at emerging markets, emerging application spaces, right? Sometimes it looks like it's a brownfield. There's incumbents, there's companies which have raised a lot of money, and there's a lot of companies out there where there's no founder market fit, right? They get in love with their technology, and then they say, hey, look, I have this really amazing team. I'm going to go after customer support, or I'm going to go after healthcare. I think when we look at companies, we like to look at founders who love the problem, not just their own solution, right? I think once have unique insights into a problem which nobody else has, then you have a right to go after that particular problem statement. And there's a lot of open spaces out there in applications where outside of customer support even, right, where you can create a big market. So we're looking at $10 billion opportunities across the application stack, and a lot of founders are not going after this because it's not obvious to them.
I want to double click on Tilly's point about unit economics. How much time are you guys thinking about unit economics in this environment? Because as a journalist following the space, I feel like such a pendulum swing amount, like, some of the investors, depends on the macro. I remember, during 2021, it was growth at all costs. And then people want to see profitability, like even if you want to thinking about, going public or any exit opportunities. But now it seems like AI is pushing that back a bit. People want to see higher growth, and you can see higher companies with higher growth getting rewarded by higher valuation. And I've seen some data that in generally AI native startups seem to burn more cash than their SaaS peers, although some of it could get better as they scale. So I'm curious, how do you evaluate or thinking about the business model and unit economics during different stages of the company?
I think, so I spend a lot of my time at the seed stage, and I don't press seed stage founders as hard on this as I do on 3 other things, which I think are the real scarce resources in the AI age. Like applying the kind of SaaS lens to an AI investment doesn't work. The 3 things that I think matter right now for seed stage AI companies is 1, velocity. Can you ship quickly? Can you move fast? Because like every week something's changing. And even like the domain where you're working, I think the half-life of a good idea to like bet your career on has shrunk from like a few months to a few weeks. So speed is the first thing. Talent density is the next thing. Like, can you attract and retain top engineers? I loved what Ryan said earlier about like proximity to the labs. Do you even know what the labs are working on? Because that can give you kind of a glimpse into the future. And the last thing is narrative. I think like this is one of the most underestimated parts of starting a company. It's like, can you tell a compelling story? Like your narrative will impact how you hire, how you sell, how you pitch investors. And those 3 things, honestly, are way more important to me than pressing a seed stage founder on unit economics. At the Series A, Series B, absolutely, you have to. But at the seed stage, I only care about those three things.
Yeah, I'll piggyback a bit off James there. I mean, I think everyone in this room has probably seen, cost per token in every single graph that is, just down and to the right? Like every week, every month, every year, et cetera. And so to a certain extent, I mean, again, I do think the point around like, well, let's just say cursor, what does that look like? I think that's a very valid question. I think ultimately, again, the seed, Series A, Series B, you're investing, over the next decade, right? And so I think you have to think about where the puck is going and if these trends will ultimately continue. And to James's point, I think everyone's point that they said, it's like, I always think about what's a founder's right to solve this problem. I think is it lived experience? Is it a personal connection? Is it a unique insight that they've gathered from, some esoteric way of living in the space? And to James's point, there's a very interesting question of, both the cost of software is just declining at a rapid pace, so software creation's becoming commoditized, right? And intelligence through these models is also becoming democratized, and so the importance of an idea is, as a result of those, I think is continuing to fall very rapidly as well, right? And so founder market fit isn't just about knowing what problem to solve, especially in these verticals that have such a gap between labor budget and software spend. A lot of these old verticals that look like that, right? And so making sure you can figure out the founder's true why, because I think there's every space will, whether it's now or in a few months, be competitive, and it's not going to be easy. And so making sure that they have a true missionary vision to why they're solving this problem is really important.
Given how competitive this market is and everybody's expecting their founder and startups to move faster, I'm curious if your dynamics in the relationship with founder also shifted. Like, do you have to, write check faster, due diligence faster? How does that affecting how you move in the market?
I think the bar has raised quite a bit, right? Both for companies to go from seed to A, for companies to go from inception to seed. The pace at which startups are moving is extremely fast. And so that's a bottom line we look for in teams. And part of that is like how VCs can react to term sheets faster as well. So I think having a thesis beforehand, circulating that within the partnership is very helpful. So we're not chasing trends, but we're investing in long-term successful spaces, right? And having said that, I think finding founders who are really good at listening and it's a partnership model is very helpful. And we don't push them to go raise $5 million to go get to $1 million in revenue. That's not the models we're looking for. It's how do you build a long-lasting company, and how do you partner with both the VCs and the industry to go build it. That is always true.
I would just want to talk about the point raised earlier. Will AI replace the VC? Because it's a little related to this question, and my opinion is a resounding no.
Ooh.
Yes, we can. And I think part of that is because what this panel is all about, which is the relationship between the founder and the investor. And I think that that relationship is a very special relationship that will last a decade, if not more, in certain cases. In many, what is most important is that there is a good relationship. And I think the best founders and the best investors will pick who they want to work with very carefully. And it could be one of the best relationships that a founder has. And I do not believe that an AI machine, even if they pick the right founder, will be able to generate that relationship, and that may be what the founder actually wants. So I view this asset class as being very much relationship oriented, which is why it's so important for us as investors and for founders to really pick well.
I mean, I agree. It is today very relationship oriented. I just don't think it will be in a steady state scenario. Like, I think there will always be the advisor, and decoupling the capital allocation from the advisor and relationship, I think will and should happen in 20 years. But 10 years, 20 years, who knows? But in the near future, I agree. Like, VC is a relationship business. It is not an arm's length capital allocation endeavor. I just think like AI or like analytics has been applied to VC in the past. Like, oh, we're gonna find companies by like looking at your LinkedIn and your digital exhaust and predicting how good of a founder you're gonna be. That just didn't work. I think the things that make someone a great founder are not traceable on their like GitHub profile and LinkedIn page. So that's why I think it hasn't worked. But why I think it will work is because now the things that matter, like predicting, you know, the or like assessing the quality of someone's narrative, their rate of execution, their talent density. Humans are good at that on average, but like a model can be better than a human at that. So I just think that eventually the relationship will be decoupled from the capital allocation.
How do you use that analytical lens to decide how much valuation you want to give up really hot companies? If it's a really hot name, like how much markup, like, because it feels like now it seems like the market is more kind of pushing up by each other. Like there, like you said, there is no set model or module you can underwrite certain valuation, especially for early stage companies.
Yeah, I mean, I think it's basically all supply demand, right? Like especially at the early stages, I don't think many people here could point to it and be like, oh, that's like the right number, right? I think it ultimately comes down to the supply of these, you know, very high quality companies in interesting spaces that are low, and then the demand of capital that, you know, wants to be in those companies. And so that's when you see, I think, a lot of these, you know, early stage companies with very high valuations. I think it's been that way for a while, and I think it'll continue to be that way. I mean, you know, everyone again has seen the amount of capital raised, and there are only so many excellent companies to deploy into, and that just, you know, from, you know, again, supply demand curve pushes up the price. I think the last thing I'd say on the previous topic is, I think for investors and founders alike, it's, you know, back to this relationship piece, it's important to understand, you know, what you're looking for, and does that relationship make sense? I think some investors make, you know, lots and lots of investments, and I think going into that relationship with what you will get out of that relationship is very different than, you know, let's just say like Maverick, for example, we make very few investments that are very concentrated every year, right? And so I think you just have to figure out ultimately what you expect from that partnership and make sure it's aligned and genuine. And I think like that's the very broad but recipe for success in making sure that, you know, the founder investor dynamic is the most productive and most healthy. So
I think today capital is a commodity, right? You can go around Sandhill, you'll get 5 or 6 term sheets. Now the question is, if you're in a fortunate situation where you have multiple funds come together, like how do you choose, right? I think every fund is different. Some funds just invest. It's an option bet. Maybe 20 companies, one will succeed, will follow on. Others, for example, like Mayfield, each partner does only a couple of deals a year. We're very concentrated portfolio, and we only work with people we like. And we also expect founders to value the relationship and work with us, right? If it was just a matter of allocation, we would not be spending as much time with a lot of different founders. I think VC founder relationship lasts longer than most marriages, right? So when founders come and want to work with, in fact, it's not just the fund, it's actually the partner within the fund. There's a whole variety of partners within a fund. So I think getting to know the partner is very, very important. And in terms of valuation, look, you can raise, maybe if you have a hot hand at a high valuation, maybe less dilution. But that makes it a hassle for your next round, right? Let's say you raise 100 post at seed round. Your next Series A is going to be higher than 100, maybe 50, right? And so you don't want to, you want to be able to turn more cards along the way. So that's why having relationship with the VCs who can help and guide you through this process is very helpful.
That's super helpful. Last lightning rounds, since we have 4 VCs here. What are the areas that you're hoping to see more founders building startups in? We'll start with you, James.
I think the world of bits is getting easier to start companies. It's getting harder comparatively to start companies in the world of atoms. So I just invested in a magnet company, for example, like more stuff like that. Optical interconnect, magnets, the stuff that's like really hard to build in the real world. I'd love to see more of that.
Yeah, I would say quantum. We've been spending some time in that area as well. So looking for that as the next kind of frontier of innovation.
Yeah, one space I'm really interested in, I've only seen a few companies, but if people are familiar with the trade desk, it's publicly traded, demand-side platform advertising, basically what that will look like in the age of AI. And there are a few companies that are starting to build there, but I think it's fascinating because I think there'll be entirely new ad infrastructure that will power, again, especially the long tail of AI-generated websites and what that looks like.
So we're investing heavily in what we call AI teammates. This is where humans work across different jobs, and how can AI help be a teammate, not a replacement, but a teammate. And this is across different sectors and different services industries.
Thank you. And with that, one of our takeaways of VC jobs are safe for now. Thank you again, Vijay, Ryan, and James, and Tilly for the great discussion.